Imagine for a moment looking at the intricate, multi-trillion-dollar global credit market. It's a system so unbelievably vast, so immensely complex, that no single player is ever supposed to be able to dictate its direction. It's like the ocean, too big for any one person to control the tides. But suddenly, you realize that gravity has entirely shifted. Supply and demand, the absolute fundamental bedrock laws of finance, are inexplicably bending to the will of an unseen force. Somebody out there is pulling levers so massive that the entire system is warping. Today, we're diving into an explainer about one of the most suspenseful, jaw-dropping mysteries in modern financial history. We're going to unravel a series of trades that were kept completely in the shadows, trades that grew so monstrously huge, they actually broke the mold of modern banking.
To really set the scene here, I want you to picture early 2012. The global markets are in a state of relative calm, but deep within the highly specialized mathematical world of credit derivatives, sharp-eyed hedge fund managers suddenly realized something was totally off. Something bizarre was happening. Someone, somewhere, was making aggressively huge trades, selling credit protection on a scale that was unprecedented. Frankly, it was almost unbelievable. It was completely warping the pricing dynamics of standardized credit indexes. Now, usually in a market this incredibly liquid, large trades are just absorbed seamlessly, a drop in the bucket, right? But this was different. This unknown entity was trading so incredibly heavily that they were single-handedly pushing global prices around. And the absolute craziest part of all this? For months, absolutely nobody knew who was sitting on the other side of the table making these massive market-breaking bets. The sheer unimaginable scale of what was happening was genuinely terrifying to market participants. This unseen force wasn't just a wealthy individual or some lucky day trader hitting a hot streak. No, they were wielding an astonishing investment portfolio worth roughly $350 billion. I mean, just let that number sink in. That single figure represented a staggering, almost apocalyptic amount of financial firepower. For a while, the entire financial world was completely clueless, just searching frantically for answers. Whispers started circulating on trading floors about a secretive trader so overwhelmingly powerful that some in the market actually referred to him as Voldemort, he who must not be named. They knew the size of the bets, they could see the market being distorted in real time, but the identity of the actor behind this multi-billion-dollar mystery, that remained entirely hidden. Let's step inside the fortress and finally reveal who was actually behind all of this. We can now pull back the curtain on this mystery. And the truth? The truth was shocking. It wasn't some reckless, newly formed hedge fund in Mayfair. It wasn't a shadowy offshore syndicate. The unseen force was operating from within the very heart of one of the world's most prestigious, historically secure financial institutions, JPMorgan Chase. Specifically, these trades were coming from a highly secretive, deeply embedded unit known as the Chief Investment Office, or the CIO, operating out of their London branch. Now, what's absolutely crucial to understand here is what the CIO was actually supposed to be doing. JPMorgan is a massive global bank, which means it takes in way more money in everyday deposits than it lends out. That leaves the bank with enormous piles of excess cash. The CIO, led by a highly respected 30-year veteran named Ina Drew, had one main job: safely manage that extra cash, invest in high-quality, boring, fixed-income securities, act as a conservative shield to protect the bank. They were supposed to be the ultra-safe fortress in JPMorgan's famous fortress balance sheet. They were absolutely not supposed to be taking wild, speculative bets. But inside this supposedly conservative, buttoned-up unit was a trader named Bruno Ixel. Working during the week from the London office, often opting for black jeans over a traditional Wall Street pinstripe suit, Ixel had been remarkably successful. He'd reportedly been bringing in around $100 million annually for the bank in previous years. But in early 2012, his massive market-moving positions in credit derivatives grew so outrageously large that the financial community stopped calling him Voldemort and gave him a new, legendary nickname, the London Whale. Because just like a massive whale in a tiny pond, every single move he made created massive, unavoidable waves. So, how exactly does a bad trade like this get built? Let's look at the anatomy of the strategy itself. How does a trader who is specifically tasked with hedging risk end up blowing a multi-billion-dollar hole in the balance sheet? Well, it all comes down to a deeply complicated, totally layered trading strategy using credit default swaps, or CDS. If you're familiar with finance, you know that buying a CDS is basically like buying bankruptcy insurance on a company's debt.
Selling one means you collect the regular premiums, but you carry the massive, terrifying risk of having to pay out if that company goes bust. The London whale was operating on both sides of this equation, playing with highly complicated indexes that bundled dozens of these companies together into one giant product. So here is the exact architecture of the disaster. Think of it like a giant wobbly house of cards. ICSL's infamous trade had three main parts. Package A involved buying CDS protection on high-yield bonds, essentially placing a bet that the economy might stumble and companies might fail. But as the economy actually started improving in early 2012, corporate defaults dropped and Package A started bleeding money fast. Now, instead of just unwinding the trade, taking the L and moving on, the CIO doubled down. They layered on a massive new position, Package B. They sold an astronomical amount of CDS protection on an investment-grade index to generate premium cash and offset the bleeding from Package A. But wait, it gets worse. When Package B started going against them, they layered on Package C, buying yet more CDS on entirely different indexes. It quickly became this monstrous, completely tangled web of competing financial bets.
And this perfectly, brilliantly illustrates the core mechanical failure of their whole strategy: basis risk. To put it simply, it's like trying to hedge your downside risk on Apple stock by buying a put option on Google. I mean, sure, yeah, they are both tech companies, and they might generally move in similar directions most of the time, but they are absolutely not the same thing. The whale's long and short positions were on completely different indexes and tranches. The trades didn't perfectly offset each other at all. Eventually, the mathematical relationship between these different credit products just completely broke down, making the whole strategy less like a tightly engineered financial hedge and more like a dog frantically chasing its own tail.
Which brings us to the core conflict that regulators and the rest of the market immediately zeroed in on. Was this actually a hedge? JPMorgan firmly, repeatedly, claimed they were simply hedging the bank's macro risks. Just protecting the castle, right? But looking at the payoff matrices, the market, and later, federal investigators, saw something entirely different. They saw incredibly risky proprietary trading. That's trading designed purely to generate aggressive, massive profits for the bank's own account. By selling those astronomical amounts of credit protection, the CIO had effectively turned themselves into a rogue internal hedge fund, betting big on the direction of the global economy, rather than just acting as the fortress they were supposed to be.
When you're driving a car that fast, you'd better be watching the dashboard. But what happens when the risk metrics completely fail? As these nested, tangled trades swelled to astronomical, unprecedented levels, the internal business gauges inside the bank started flashing bright, blinding red. Now, a bank like JPMorgan has incredibly sophisticated systems in place designed to prevent this exact scenario. The most important gauge on their dashboard was something called value at risk, or VAR. It's a crucial risk management metric that essentially calculates the absolute maximum expected loss a portfolio might face on any given day. In January 2012, as the whale's massive positions expanded, the CIO breached its VAR limit for 4 straight days. The portfolio was becoming incredibly, undeniably dangerous. This absolutely should have been the moment the bank slammed on the emergency brakes, ordered the trades unwound, and stepped back. But that is not what happened. In response to the VAR breach, instead of shrinking those massive risky positions, the bank did something truly astonishing. They literally just changed the math. They implemented a brand new, highly complex VAR model that hadn't even been fully vetted yet. And miraculously, the very moment they plugged the whale's trades into this new formula, it artificially cut the reported danger squarely in half. The flashing red lights suddenly turned green. Not because the actual risk was gone, mind you, but because they had effectively reached under the dashboard and muted the alarm. The Senate investigation later criticized this relentlessly, pointing out that risk managers completely failed to step up, put their foot down, and challenge the trading strategy.
So the really crucial point here is this incredible dramatic irony unfolding behind closed doors. By April 2012, rumors were finally starting to leak out to the financial press about this so-called London whale. JPMorgan CEO Jamie Dimon famously and very publicly dismissed the media reports on an earnings call, calling the whole thing a tempest in a teapot. He was signaling complete, unbothered confidence to the outside world. Yet deep inside the London office of the bank, the reality was utterly terrifying. Bruno ICSL himself was frantically writing internal emails, explicitly warning his own supervisors that the trades were completely failing. He literally wrote, "We have to report a loss. We have to let the book simply die." The disconnect between the CEO's public confidence and the traders' internal panic was just absolute. And as the losses inevitably mounted, the story shifts from just bad judgment into something much darker.
Investigations later claimed that the daily valuation marks of the entire portfolio were deliberately being manipulated. You see, in the complex derivatives market, you have to value your books every single day to see where you stand. Normally, you use the crude mid, which is just the fair mathematical midpoint between the market's bid and ask prices. Instead, traders were allegedly directed to use prices deliberately chosen to minimize the reported losses. They were actively masking the bleeding, trying desperately to hide this accelerating multi-billion-dollar financial crater from senior management and the firm's own controllers.
But you can't hide a problem this big forever. Let's look at the squeeze, when there was blood in the water.
Like I said, you cannot hide a whale in a swimming pool forever. By the spring of 2012, the broader financial market fully realized that this clumsy, massive giant was trapped. The prices of the indexes the whale was trading were completely disconnected from reality, and the sharks began to circle. Brilliant hedge fund managers, most notably Boaz Weinstein of Saba Capital Management, noticed the whale's massive pricing distortions. They realized that buying credit protection on the index was suddenly much, much cheaper than buying it on the underlying companies. It was a clear, glaring market anomaly caused solely by JPMorgan's massive selling pressure. Knowing full well that JPMorgan couldn't easily escape such a massive, illiquid position without crushing themselves on the way out, these hedge funds aggressively took the opposite side of the trades. They literally smelled blood in the water, and they pounced. They effectively squeezed the whale, forcing JPMorgan into a corner where they had no choice but to recognize the catastrophic losses. Let's walk through exactly how fast this whole thing unraveled. It builds from just a few ignored warnings to a historic banking disaster in months. In January, the trades aggressively expand and those crucial VaR limits are breached. By March, internal panic sets in and trading is finally ordered to halt, but it's too late. The massive positions are already locked in. In April, the media catches wind of the distortions, but the CEO publicly denies the severity. Finally, the dam just totally breaks. In May 2012, the bank is forced to officially, painfully disclose the massive, undeniable reality of their flawed strategy to the public, the shareholders, and the regulators.
So what happens when the dust settles? Let's dive into the aftermath of a multi-billion-dollar lesson. The sheer financial toll of this single, unbelievably complex derivative strategy failing was nothing short of historic. It sent massive shockwaves through Wall Street, Washington, D.C., and the entire global regulatory environment. When Jamie Dimon held that incredibly tense emergency conference call in May, he initially announced what he called a painful $2 billion mistake resulting from a poorly reviewed, poorly executed hedging strategy. But as they painstakingly tried to unwind these massive, highly illiquid positions over the coming months, that $2 billion rapidly ballooned. It ultimately resulted in a staggering $6.2 billion crater on JPMorgan's balance sheet, a multi-billion-dollar loss generated by a department whose literal, sole job was to keep the bank's cash safe. The business consequences of this were immediate, public, and severe. JPMorgan Chase agreed to pay over $20 million in massive regulatory fines to authorities in both the US and the UK. CEO Jamie Dimon actually had his annual pay slashed right in half, dropping from $23 million to $11.5 million. Multiple top executives, including Chief Investment Officer Ina Drew, were forced out of the company entirely. And perhaps most significantly for the broader financial industry, this entire massive debacle poured absolute gasoline on the regulatory fires in Washington. It heavily intensified the scrutiny and the final implementation of the Volcker Rule, which was a regulation specifically designed to ban commercial banks from doing this exact type of risky proprietary trading with their own accounts.
Now, impartially speaking, when you look back at all the documents, the emails, and the testimonies, the narrative of who is truly to blame remains fiercely split to this day. The bank's official internal task force pointed firmly to egregious mistakes made by a handful of poorly supervised rogue traders who allegedly hid their accelerating losses. On the other hand, Bruno Ixel himself later broke his silence, maintaining that he was unfairly scapegoated by the institution. He pointed out that his actions and his specific trading strategies had actually received continuous, permanent approval from senior management all along, and that he had actively, repeatedly warned his superiors about the escalating risks. It's your classic, high-stakes Wall Street standoff, rogue execution versus systemic, top-down management failure. Which leaves us with this final, incredibly provocative thought. You have to remember, JPMorgan Chase was widely considered to be the smartest, safest, most well-managed bank in the entire world. They literally trademarked the concept of a fortress balance sheet. Yet even they managed to hide a $6.2 billion blind spot in their own supposedly conservative Treasury Department. So, if the world's absolute most sophisticated risk models and the sharpest, highest-paid banking executives on Earth can completely fail to see a massive whale thrashing around in their own waters, how safe and how understood are the complex derivatives that underpin our global markets today? It's a mystery and a question that every single investor needs to keep in the back of their mind.